Stay with me for the next few minutes because what I'm about to walk you through connects three things that most people in this space are not looking at together: the next global financial crisis, BlackRock's quiet move toward XRP, and what the US government just decided about a digital dollar. This is the full picture. Let's go. What's up, everyone? John OG here. I research the deep layer fundamentals of crypto and global finance, so you don't have to dig through 100 articles to understand what's actually happening. Let's break this down properly. Quick disclaimer before we get into it: everything in this video is strictly for educational and informational purposes. Nothing here is financial advice. Crypto markets are volatile. Please do your own research and speak with a qualified professional before making any investment decisions. Now let's get into it. Let me start with a number that most people scroll past without really absorbing it. $27 trillion. That is the estimated amount of capital that sits completely idle right now inside the global correspondent banking system, locked in Nostro and Vostro accounts that exist solely to pre-fund cross-border transactions. It earns nothing. It moves nothing. It just waits. That is not a niche banking problem. That is a foundational design flaw in the architecture of global finance. And the next financial crisis, whether it comes from geopolitical escalation, a sovereign debt spiral, a currency shock, or a liquidity seizure triggered by an unwinding carry trade, will put that $27 trillion problem directly under a spotlight. And when that spotlight hits, XRP will be the most visible solution on the table. That is not hype. That is the structural reality of what Ripple has been building for over a decade. Here is how I think about it. Every financial crisis in modern history has had a liquidity component. When Lehman Brothers collapsed in 2008, the problem was not just bad assets on the balance sheet. The problem was that the plumbing of global finance, the system that moves value between institutions across borders in real time, seized up. Banks stopped trusting each other, capital stopped moving, and the cascading effect nearly took down the entire system. The solution was emergency interventions, printed money, and years of patchwork repair on a system that was never designed for the speed and complexity of modern global finance. Now ask yourself, what would that same scenario look like in 2026, in a world where geopolitical tensions between major nuclear powers are elevated, where the Strait of Hormuz is under pressure from an escalating Middle East conflict, where the Japanese carry trade remains a multi-trillion-dollar risk sitting underneath every major market, and where sovereign debt levels across the developed world are at historic highs? The answer is that the next liquidity shock would be faster, deeper, and harder to contain than 2008, and the existing infrastructure, SWIFT, correspondent banking, Nostro Vostro, would be the first thing to buckle. XRP's entire design premise addresses exactly that scenario: 3 to 5 second settlement, fractions of a penny per transaction, a fixed supply that does not inflate under political pressure, a network running over 900 nodes globally, monitored in real time using AI infrastructure built with Amazon Web Services, and a token that functions as a neutral bridge currency, not tied to any single government, not subject to sanctions in the same way a dollar-based correspondent banking relationship would be. In a world where the financial plumbing is under maximum stress, XRP is not just a speculative asset, it is a crisis-ready liquidity solution that no existing technology can replicate at scale. Now let's talk about BlackRock, because this is where the narrative starts to get very interesting, and where a lot of people in the XRP community are drawing conclusions that are either slightly ahead of the data or slightly behind it. I want to give you the honest, nuanced version. As of February 2026, BlackRock manages roughly $10 trillion in assets. They are the largest asset manager on the planet, and their public statements about digital assets in 2026 have been unusually direct. At the Bank of America conference on February 16, 2026, BlackRock's leadership touted plans to tokenize their flagship iShares ETF lineup, push into what they called digital wallet native asset management, and grow fee revenue by 6 to 7% through digital asset infrastructure. Bitwise CIO Matt Hugin described BlackRock's tokenization move on February 11th as a narrative that could define the next decade of asset management. The firm also reported that its XRPI product, a spot XRP ETF, had accumulated $960 million in inflows, making it the dominant XRP ETF by assets under management. Let me pause on that for a second. BlackRock is already exposed to XRP through XRPI. They are accumulating assets under management in XRP as we speak. They have confirmed plans to tokenize iShares ETFs and distribute them through digital wallets. And Canary Capital CEO Stephen McClurg, the man who filed the first spot XRP ETF in the United States, stated explicitly that BlackRock will likely file their own spot XRP ETF by late 2026 or early 2027 once XRP ETF assets under management reach $3 billion. Based on current inflow trajectories, that $3 billion threshold is closer than most people realize. But here is the layer of this story that almost nobody is discussing. When BlackRock tokenizes iShares ETFs, which represent stocks, bonds, commodities, real estate, they are going to need a settlement layer that can handle the volume, speed, and compliance requirements of institutional-grade, real-time, cross-border asset movement. Right now, BlackRock's own thematic 2026 outlook names Ethereum as the primary tokenization infrastructure layer. That is important to acknowledge, and I am not going to pretend it is not in the data. But the XRPL is growing faster in the 30-day real-world asset category than Ethereum, Solana, Polygon, and Avalanche combined, according to recent on-chain data. The XRPL now holds over $2.3 billion in tokenized real-world assets, more than doubling from under $1 billion at the start of 2026. And this matters for the BlackRock thesis in a very specific way. When an institution the size of BlackRock moves into tokenization at scale, they do not pick one blockchain and stay there forever. They pick the chains that serve specific use cases best. Ethereum has the developer ecosystem and the existing DeFi depth, but XRP has the institutional regulatory profile, OCC Trust Charter, Genius Act compliance, ISO 2022 alignment, MyCA compliant stablecoins already live on the ledger. When the tokenization boom hits its full stride and institutions need real-time settlement for trillion-dollar flows, the XRPL's 3 to 5 second finality and sub-cent transaction costs are not a nice-to-have. They become a requirement. My opinion on this, and I want to be transparent that this is my read of the data, is that BlackRock is not ignoring XRP. They are already in it through XRPI. They are watching the adoption curve. And when the data tells them the market depth and liquidity are sufficient, they will move. That is exactly what they did with Bitcoin. They watched, they waited, and then they filed for the largest Bitcoin ETF in history and accumulated faster than anyone expected. The XRP ETF story is at a very early stage of that same arc. Now let me address the CBDC question, because it is central to understanding where the US is heading on digital finance and why it actually creates more opportunity for XRP, not less. Here is the political reality as of March 2026. President Trump signed an executive order in January 2025 explicitly prohibiting federal agencies from pursuing a central bank digital currency. The Anti-CBDC Surveillance State Act has been introduced in the House and is included in the broader Digital Asset Market Clarity Act, the Clarity Act, which the Trump administration has been actively pushing to pass. On March 2, 2026, the Senate Banking Committee's bipartisan Road to Housing Act included a provision banning the Federal Reserve from issuing a CBDC before 2031. That is a 5-year legislative block on the Federal Reserve's ability to issue a programmable central bank digital currency directly to the public. So the digital dollar is not coming in the form of a Fed-issued CBDC, at least not for the foreseeable future. The Trump administration has made that absolutely clear. But here is what is coming instead. And this is where the XRP opportunity becomes very specific. The Genius Act, signed into law in July 2025, created the most comprehensive regulatory framework for private sector payment stablecoins in American history. It requires stablecoin issuers to comply with the Bank Secrecy Act, hold reserves in high-quality liquid assets, and operate under either federal or state oversight. What it enables is a world where private institutions, not the Federal Reserve, issue the digital versions of the dollar. And who has a Genius Act-compliant stablecoin already live and growing? Ripple, with RLUSD. As of early 2026, RLUSD has grown 1,800% year-on-year, from $72 million to $1.38 billion in assets. It is approved by the Abu Dhabi Financial Services Authority, approved by Dubai regulators, recently expanded into Bahrain, and is actively used by financial institutions for cross-border settlement. This is not a small development. The US government just told the world that the digital dollar will be private sector issued, not government issued, and Ripple is one of the most well-positioned private issuers in the world. RLUSD runs on the XRP Ledger, and every time RLUSD is used to settle a cross-border transaction, it reinforces the infrastructure case for XRP as the liquidity layer underneath it. The CBDC that is coming is not a single government-issued token. It is a fragmented private sector ecosystem of compliant stablecoins settling across regulated ledgers. And in that ecosystem, XRP's role is not to be the coin itself. It is to be the bridge, the neutral, fast, low-cost settlement layer that connects dollar stablecoins to euro stablecoins to yen stablecoins to every other fiat-backed digital currency operating in the new system. That is the role XRP was designed for, and that is the role that is now legally enabled by the regulatory framework the United States just put in place. Let me bring this together into what I think is the honest, grounded picture for XRP holders in 2026 and beyond. Three forces are converging simultaneously, and the timing of that convergence is unusual in its precision. First, the next financial crisis, whatever form it takes, will expose the fragility of the existing correspondent banking system and amplify demand for faster, cheaper, more resilient settlement infrastructure. Second, BlackRock and the largest asset managers on the planet are moving into tokenized finance at scale, which will require settlement layers that can handle institutional volume at institutional compliance standards. Third, the U.S. government has created a regulatory environment that blocks government-issued digital currency while actively enabling private sector stablecoin issuers, and Ripple is one of the most compliance-ready, globally approved issuers in that new ecosystem. XRP sits at the intersection of all three forces. That does not mean the price goes up tomorrow. Markets are messy, geopolitics are unpredictable, and the gap between infrastructure adoption and price action can last longer than any of us want it to. Exchange reserves for XRP are at a 7-year low, which tells you something real about supply compression. Spot XRP ETFs crossed $1.3 billion in assets under management in their first 50 days, the fastest altcoin ETF ramp in history. Ripple has deployed $4 billion in strategic acquisitions: Hidden Road, now Ripple Prime, G Treasury, Rail, Palisade, building a banking-grade financial stack that no other crypto company can match. And JP Morgan, as of March 2026, confirmed that passage of the Clarity Act by mid-2026 could unlock institutional capital flows that would be a major positive catalyst. The question I get asked most often is, when? When does the price reflect all of this? And my honest answer is, I do not know the exact timing, and anyone who gives you a specific date is speculating. But what I do know is that the architecture being built right now is not being built for a speculative pump. It is being built by trillion-dollar institutions for a financial system they intend to use for decades. And the people who understand that, the people who are accumulating quietly, rather than chasing price action, are likely to be in a very different position when the inflection point arrives. That is the full picture as I see it today. If this added real value to your understanding of where XRP sits in the global financial transition, please hit the like button. It makes a genuine difference to the channel's reach. Subscribe and hit the notification bell so you catch every deep dive. And drop your thoughts in the comments. I read everything, and I want to hear where you think this goes. I'm John OG. Stay patient, stay grounded, and I will see you in the next one.